There are many investment options available to all of us in today's world. Each investment option or choice is called investment asset class. While choosing any investment options, we need to keep a few things in mind. Questions to ask before making investments. Number one, what is the risk? Number two, what is the return in each asset class? Number three, is it a growing or depreciating asset class? Number four, how stable is the asset class? And lastly, number five, how does it compare to the rate of inflation? Before we get into these details, let me do some myth busting. There is a general perception that savings in the form of cash is safe. Well, the answer is a big no. Someone may steal it. It may get destroyed in some natural disaster, fire, or some accident. Your money is completely lost, not safe at all. In addition to this, you have to learn and remember how you can keep it safe and how you should not just let it go away. The value of cash money keeps decreasing every year. How? Let me explain to you. Money in cash is lying idle. This money is not working for you. In high inflation countries like India, the value of money keeps depreciating each year. In simple language, it keeps losing its value every year. Let me give you an example. If you Google and find the value of 1000 rupees, say 50 years ago, it was like 20 rupees. Yes, you heard it right. Which means if an item cost 20 rupees 50 years ago, that same product should now be available for 1000 rupees, 50 times more. So the moral of the story, savings in cash is a big waste. If you talk to our grandparents, they will tell you that bank deposits are the safest of all. The fact is, money in your bank is also not and never 100% safe. Every government has a policy. If the bank goes bankrupt, or let us say it shuts down, the government nor the bank is obliged to return your investments. Entire money of investors is 100% lost. In India, the law says no matter how much money you have saved in your bank, if the bank goes bankrupt, each account holder will get a maximum of rupees 5 lakh. So even if you had 5 crore in the bank, what you only get is 5 lakh rupees. In the US, this amount is $250,000, and in the UK, it is 85,000 pounds. That's it. So, how safe is a bank deposit? Shocking, right? So, money being safe in the safe asset class is a myth. Any kind of investment has an element of risk. So, we have to learn how to minimize our risk. With this basic clarity, now let us evaluate the most popular investment options. As investors, the most popular investment options are as follows. 1. Bank fixed deposits. 2. Government bonds. 3. Gold. 4. Real estate. 5. Cryptocurrency. 6. Mutual funds. And 7. Stock markets. Amongst this list, the most stable ones are bank fixed deposits, bonds, real estate, and gold. The most risky ones are cryptocurrency, mutual funds, and stock markets. The returns from each of the asset classes are in the next slide. Amongst the safest ones, gold has given the best return of 10% annualized over 40 to 50 years. This means it has grown by 10% average. Amongst the risky ones, cryptocurrency has given the highest return, but it is extremely unstable, unpredictable, and too new. It is a very high risk. It has a very wide fluctuating return. Mutual funds and stock market has given a return of 15 to 18% in India and an attractive 10 to 15% in the global markets. As you can see, stock markets gives you the best returns. But wise people never put all their money in one asset class. It is safe to assume that there should be a decent 5 to 10% in cryptocurrency, a good 20 to 50% in bonds and golds, and the rest in stock markets. Now, I'm going to be adding one more layer of information. It may sound tricky, but it is very valuable information. In fact, I'll share it with your parents too, because many adults also do not think about it. A good benchmark to decide the best asset class is to compare it with the rate of inflation in the country. For example, in India, the rate of inflation is 8%. So bank interest rates, bonds, etc., at 4 to 8% returns are lower than inflation. This is not good. Gold, on the contrary, at 10% return is 30% higher than inflation, which is good. But the stock market at 18% return is 200% higher than inflation. This is really a big return. This makes me happy. So my friends, this was a lot of information, so I will summarize it to make it simple. Number 1, every investment is a risk. Number 2, money in cash and in banks is also a risk. Number 3, returns must be compared with the rate of inflation. Number 4, bank deposits and bonds are safe. Number 5, but give lower returns when compared to inflation. Number 6, gold is safe and gives a 30% higher return than inflation. Number 7, stock markets and mutual funds are risky. Number 8, but gives 200% better return than inflation. Having said that, in my next episode, I will explain why stock market is not a risk. Yes, the perception is that it is a risk, but actually it is not.